What if I told you that the richest corporations in the United States are not rich in the way most people understand wealth? Their logos dominate cities. Their market value is measured in trillions of dollars. Their executives speak the language of power, innovation, and inevitability. And yet, strip away expectations, cheap capital, and financial engineering, and many of these giants would not survive on their own cash flow. This is not a story about bad management or temporary downturns. This is a story about a system that learned how to reward scale instead of strength, narratives instead of numbers, and belief instead of proof. For years, markets celebrated companies that did not need to earn money, only to promise that one day they would. For years, debt replaced discipline, valuation replaced profitability, and access to capital replaced economic survival. The question is no longer whether this model works. The question is what happens when it stops being optional to prove that it does. The modern public conversation about corporate wealth is built on a dangerous misunderstanding. When people say that the largest corporations in the United States are rich, they are almost never talking about cash, profitability, or financial resilience. They are talking about market capitalization, brand valuation, and stock performance. These metrics look impressive, dominate headlines, and create the illusion of strength, but they do not describe how a company survives when conditions tighten. A corporation can be described as wealthy while generating weak operating cash flow, carrying massive debt, and relying on external financing to sustain its business model. This contradiction is not accidental. It is the result of a structural shift in how markets define success. Market capitalization has become the dominant symbol of corporate power. It is calculated by multiplying the share price by the number of outstanding shares, which means it is driven primarily by investor expectations rather than by actual earnings. When expectations rise, capitalizations explode, even if profitability stagnates or disappears. Over the past decade, some of the most famous American corporations reached valuations measured in trillions of dollars, while their net margins fluctuated wildly or collapsed entirely during periods of economic stress. This disconnect matters because valuation reflects belief, not resilience. Belief can evaporate faster than revenue. Profitability used to be the core metric of corporate health. A company sold goods or services, covered its costs, paid its obligations, and retained earnings for growth. Today, profitability is often treated as optional, delayed, or even strategically undesirable. Many corporations prioritize revenue growth, user expansion, or market dominance while accepting years of losses. In isolation, this might appear irrational, but within the modern financial system, it is rewarded. Investors have been trained to value scale and future potential over present cash generation, especially in an environment saturated with liquidity. Economic data illustrates this shift clearly. Over the past 2 decades, corporate revenues in the United States have grown steadily, but net income growth has been far more volatile. Operating margins for several major sectors compressed despite rising prices and expanding market reach. Meanwhile, stock prices continue to climb, driven by low interest rates, aggressive monetary policy, and the assumption that future profits would eventually justify current valuations. This assumption became embedded in market psychology. The result is a corporate landscape where valuation inflation outpaces operational reality. Another critical element is the distinction between accounting profit and economic profit. Accounting profit can be engineered through depreciation schedules, stock-based compensation, asset revaluations, and tax strategies. Economic profit, which reflects real value creation after the cost of capital, is far harder to sustain. Many large corporations report positive earnings while destroying economic value when financing costs, dilution, and long-term liabilities are considered. Shareholders see growth, but the underlying engine weakens. Recent global events expose this fragility. Supply chain disruptions, rising input costs, and tightening labor markets revealed how thin corporate margins had become. Companies with massive brand recognition struggled to maintain profitability when external conditions shifted. Yet their market valuations often recovered faster than their earnings, fueled by optimism, stimulus, and expectations of future policy intervention. The gap between perception and performance widened further. Debt amplifies this illusion of wealth. Cheap borrowing allowed corporations to fund expansion, acquisitions, and share repurchases without relying on internal cash generation. Balance sheets grew, but so did obligations. Servicing this debt was manageable when interest rates were near zero. As rates increased, debt servicing costs consumed a larger share of operating income, exposing how little margin for error many corporations actually had. A business can appear wealthy while being structurally vulnerable. The media reinforces this misunderstanding by focusing on rankings, valuations, and brand power. Headlines celebrate trillion-dollar companies without examining how much free cash flow they generate relative to their obligations. Investors are shown charts of stock performance, not breakdowns of balance sheet risk. This selective framing creates a narrative of unstoppable corporate strength, even as the fundamentals erode. The truth is that corporate wealth, as it is commonly described, is largely symbolic. It reflects access to capital markets, confidence in management narratives, and the momentum of financial flows. It does not guarantee durability. When profitability weakens, companies compensate with borrowing, restructuring, and financial engineering. These tools delay reckoning, but they do not eliminate it. This is why some of the largest corporations in the United States can be simultaneously described as dominant and fragile. They command enormous valuations while operating with thin margins, high leverage, and dependence on favorable financial conditions. Their wealth exists primarily in expectation form. It is priced into shares, not stored in cash. It survives as long as confidence holds. Understanding this distinction is essential. Without it, investors, policymakers, and the public mistake valuation for strength and scale for stability. The modern corporation does not need to be profitable to be celebrated. It needs to be convincing. And as long as markets continue to reward belief over balance, the illusion of corporate wealth will persist, even as the underlying economics grow increasingly unstable. The transformation did not happen overnight. It unfolded quietly, reinforced by policy decisions, market incentives, and a gradual change in how success was measured. Large American corporations did not suddenly abandon profitability. They were taught that they no longer needed it. The shift began when access to capital became easier than access to real growth. Once borrowing was cheaper than earning, the logic of corporate behavior changed permanently. For most of the 20th century, capital was a constraint. Companies expanded cautiously because funding was limited, interest rates reflected real risk, and investors demanded tangible returns. Profit was not just a goal, it was proof of survival. A business that failed to generate consistent earnings eventually disappeared. Losses were tolerated only temporarily, usually during expansion or crisis. The system punished inefficiency naturally. That discipline eroded when monetary policy entered a new era. Central banks began flooding markets with liquidity to stabilize economies after repeated shocks. Interest rates were pushed downward and held there for years. The cost of capital collapsed. Debt became abundant, predictable, and cheap. For large corporations with access to bond markets and institutional investors, financing shifted from obstacle to advantage. Borrowing was no longer a sign of weakness. It became a strategic tool. Once capital was plentiful, the hierarchy of corporate priorities inverted. Growth metrics replaced profit metrics. Revenue expansion, user acquisition, market share, and brand dominance were elevated above margins. Investors accepted losses as long as a convincing story accompanied them. The promise of future dominance justified present inefficiency. The larger the company grew, the more patient the market became. Financial data reflects this behavioral change clearly. Over the past decade, corporate debt issuance in the United States expanded dramatically, while retained earnings as a share of corporate financing declined. Companies increasingly funded operations, acquisitions, and even routine expenses through borrowing rather than through internally generated cash. Net debt levels rose even as profits stagnated. This was not an accident. It was rational behavior in an environment where capital markets rewarded scale more than sustainability. The structure of executive incentives reinforced the pattern. Compensation packages emphasized stock performance, revenue targets, and adjusted earnings metrics. Short-term profitability was often deprioritized in favor of long-term narratives that supported valuation. Executives were rewarded for expanding balance sheets, not strengthening them. Share prices rose, bonuses followed, and the cycle repeated. Cheap capital also distorted risk perception. When interest rates remain low for extended periods, leverage appears harmless. Debt servicing costs remain manageable, even for highly leveraged firms. This creates a false sense of security. Corporations begin to assume that favorable conditions are permanent. Business models are built around continuous refinancing rather than repayment. Debt maturity schedules are extended, obligations rolled forward, and liquidity dependence normalized. Global economic events further accelerated this dependency. During periods of crisis, governments and central banks intervened aggressively to prevent corporate failures. Emergency lending facilities, bond purchase programs, and fiscal support protected large companies from market discipline. These interventions were framed as temporary, but their long-term impact was structural. Corporations learned that size provided insulation. Being large meant being systemically important. Systemic importance meant access to rescue. As a result, the traditional boundary between private enterprise and public support blurred. Losses were absorbed by balance sheets during good times and socialized during bad times. This asymmetry encouraged risk-taking. If profits were private but survival was guaranteed, the incentive to prioritize efficiency weakened. Corporations optimized for expansion, not resilience. Accounting practices adapted to this environment. Non-cash expenses, stock-based compensation, and adjusted earnings metrics became standard tools for presenting performance. Reported profits often excluded significant costs. Investors learned to focus on narratives rather than raw numbers. A company could lose money operationally while still being described as healthy, as long as its revenue curve pointed upward. The bond market played a critical role in sustaining this system. Institutional investors, pension funds, and asset managers needed yield in a low-rate world. Corporate bonds provided it. Demand for debt remained strong even as leverage increased. Credit spreads compressed. Risk was mispriced. Large corporations were able to issue debt at favorable terms, regardless of underlying profitability. Access to financing became self-reinforcing. This dependency on cheap capital reshaped corporate culture. Finance departments gained influence over operations. Strategic decisions prioritized capital structure optimization rather than productivity improvements. Mergers and acquisitions became more attractive than organic growth. Buying competitors was often cheaper than competing with them. Market concentration increased, further reducing pressure to improve margins. The paradox deepened when interest rates eventually began to rise. Companies accustomed to cheap capital faced higher servicing costs, but many were already structurally dependent on refinancing. Rather than reducing leverage, they relied on pricing power, cost-cutting, or further borrowing to manage obligations. Profitability remained secondary. Survival depended on maintaining market access, not on generating cash. This is the core of the modern corporate dependency. Large American corporations are not addicted to debt because they are reckless. They are dependent because the system trained them to be. Cheap capital removed the necessity of profit. Repeated interventions removed the fear of failure. Markets rewarded growth stories regardless of cash flow. Over time, the expectation of easy financing became embedded in business models. The result is a corporate ecosystem where profitability is no longer the primary condition for success. Access to capital is. As long as corporations can borrow, refinance, and attract investors, losses can be sustained and deferred. Wealth is measured by valuation, not by solvency. Strength is inferred from size, not from stability. This dependency sets the stage for fragility. When profitability is optional, efficiency erodes. When capital is abundant, discipline disappears. And when corporations forget how to survive without external support, the system becomes vulnerable to even modest disruptions. The illusion of strength persists, but it is built on a foundation that assumes cheap capital will always be available. That assumption has not yet been fully tested. The assumption that cheap capital will always be available is not theoretical optimism. It is embedded into balance sheets, refinancing schedules, and strategic planning documents across corporate America. Entire business models now depend on the ability to roll debt forward rather than extinguish it. This marks a fundamental departure from historical norms, where leverage was a temporary accelerator, not a permanent operating condition. One of the clearest indicators of this shift is the changing relationship between operating income and interest expense. In previous decades, interest coverage ratios were conservative by necessity. Companies maintained buffers because access to capital was uncertain. In the modern environment, those buffers thinned. As long as refinancing remained possible, coverage ratios became secondary. The logic was simple. If debt can always be replaced, repayment is optional. This mindset quietly transformed leverage from a risk into a routine. Capital markets reinforced this behavior through valuation mechanics. Equity investors rewarded expansion funded by debt as long as it increased scale or market dominance. Bond investors assumed that large corporations would always find liquidity, either privately or through systemic support. Rating agencies adapted by placing greater emphasis on size, diversification, and perceived strategic importance rather than on strict profitability metrics. The feedback loop was complete. Corporations borrowed because markets allowed it, and markets allowed it because corporations were already borrowing. The rise of passive investment further diluted discipline. Trillions of dollars flowed into index funds and exchange-traded products that allocate capital mechanically rather than analytically. As long as a corporation remained large enough to stay in major indices, it attracted continuous inflows regardless of financial quality. This removed a critical layer of scrutiny. Capital allocation became automatic. Market presence replaced performance as the key criterion. This dynamic created a class of corporations that are functionally insulated from traditional market punishment. Declining margins no longer triggered capital withdrawal. Rising debt did not immediately affect valuations. Weak cash flow was reframed as temporary or strategic. In this environment, the distinction between sustainable and unsustainable businesses blurred. Everything appeared viable as long as financing remained accessible. Global policy responses to economic shocks intensified this effect. During periods of instability, liquidity injections were justified as emergency measures. However, repeated interventions normalized the expectation of support. Corporations adjusted accordingly. Liquidity planning assumed policy backstops. Risk management incorporated the likelihood of intervention. What began as crisis response evolved into structural dependency. This dependency reshaped corporate time horizons. Long-term profitability became less urgent than short-term valuation stability. Investments prioritized optics over efficiency. Marketing, narrative control, and financial communication gained prominence relative to operational excellence. Shareholder letters emphasized vision and scale while downplaying margins and return on capital. The market listened. Even innovation was affected. Instead of focusing on productivity gains, many corporations pursued growth through acquisition. Buying revenue was faster and more predictable than building it. Cheap debt made acquisitions attractive, even when synergies were questionable. The result was balance sheet expansion without proportional improvement in cash generation. Scale increased, resilience did not. As leverage accumulated, corporate sensitivity to interest rates increased dramatically. Small changes in financing conditions began to have outsized effects on cash flow. Yet instead of reducing exposure, many corporations doubled down, assuming that rates would eventually fall again. This belief was not irrational within the context of the previous decade. It was learned behavior, reinforced by experience. When monetary conditions tightened, the response was revealing. Rather than deleveraging aggressively, corporations adjusted narratives. Cost-cutting replaced restructuring. Price increases compensated for margin pressure. Workforce reductions preserved earnings optics while leaving capital structures largely intact. The objective was not to restore balance, but to survive until financing conditions improved. This behavior exposes the core fragility of the system. Corporate survival is increasingly decoupled from economic productivity and increasingly tied to financial continuity. As long as capital markets function smoothly, the system holds. When they do not, weaknesses surface rapidly. Liquidity becomes a single point of failure. The broader economy absorbs the consequences. Investment becomes skewed toward large incumbents. Competition weakens. Innovation slows. Productivity gains lag. Wealth concentrates in entities best positioned to access capital rather than those most capable of creating value. This is not a malfunction. It is the logical outcome of an economy where capital abundance overrides economic discipline. The most dangerous aspect of this structure is its invisibility. From the outside, everything appears stable. Markets remain elevated, corporate valuations stay high, financial headlines celebrate resilience. But beneath the surface, dependency deepens. Profitability becomes cosmetic. Solvency becomes conditional. Stability becomes performative. When profitability is no longer required for survival, it eventually disappears as a priority. When discipline is no longer enforced by markets, it erodes internally. And when corporations forget how to function without continuous refinancing, the entire system becomes exposed to shocks that would once have been manageable. This is not a prediction of imminent collapse. It is a description of accumulated vulnerability. The modern American corporate model has traded resilience for expansion, discipline for liquidity, and profit for perception. As long as capital remains cheap and accessible, the system appears strong. When that condition changes, the illusion dissolves quickly. The question is not whether this dependency exists. It is how long it can persist before capital demands proof instead of promises. Once profitability lost its central role, a vacuum emerged. Markets still demanded growth, stability, and rising share prices, but traditional business performance could no longer reliably deliver them. Into that vacuum stepped financial engineering. What had once been a supplementary tool became the primary mechanism through which large American corporations sustained their image of success. Balance sheets turned into instruments of narrative control. Earnings became adjustable. Reality became negotiable. Financial engineering is often misunderstood as a set of obscure accounting tricks. In reality, it is a comprehensive strategy that reshapes how performance is measured, presented, and rewarded. It does not necessarily involve illegal practices. It involves optimization within the rules, exploiting flexibility in standards, and directing attention toward metrics that flatter rather than illuminate. Over time, this approach became normalized, even celebrated, because it aligned perfectly with market incentives. One of the most powerful tools in this arsenal is share repurchasing. Stock buybacks reduce the number of outstanding shares, mechanically increasing earnings per share, even if total profit remains flat or declines. This allows corporations to present growth where none exists operationally. Over the past decade, American corporations spent trillions of dollars on buybacks, often exceeding their net income. In many cases, these repurchases were funded through borrowing rather than through surplus cash. Debt replaced equity. Balance sheets weakened, but share prices rose. Buybacks also serve another function. They provide continuous demand for a company's own stock, supporting prices during periods of weak external interest. This creates an artificial floor under valuations. Executives justify these programs as efficient capital allocation, yet the timing often coincides with periods of slowing growth or declining margins. Instead of investing in productivity or resilience, corporations invest in optics. Adjusted earnings metrics further blur the line between performance and presentation. Companies increasingly report non-standard profit measures that exclude costs deemed non-recurring, non-cash, or exceptional. Over time, these exclusions become routine. Stock-based compensation, restructuring charges, acquisition costs, and impairment losses are frequently removed from headline figures. What remains is a curated version of profitability designed to meet expectations. Stock-based compensation itself is a critical component of this system. It allows companies to pay employees without using cash, preserving liquidity while diluting shareholders. From an accounting perspective, it reduces reported expenses in ways that appear benign. From an economic perspective, it transfers value from existing owners to management and staff. Yet markets often overlook this dilution, focusing instead on adjusted earnings growth. Tax optimization adds another layer. Multinational corporations exploit jurisdictional differences to minimize tax liabilities, inflating after-tax earnings without improving underlying operations. Profits are shifted geographically, not created. Effective tax rates fall, boosting net income figures. Governments tolerate this behavior because corporations provide employment and political leverage. Shareholders accept it because it enhances reported profitability. The system rewards the appearance of efficiency rather than the substance. Debt structuring is used strategically to manage perceptions of risk. Maturities are extended, interest payments deferred, covenants relaxed. Complex instruments obscure true leverage. Off-balance sheet arrangements hide obligations. Leasing structures move liabilities into footnotes. The goal is not deception in the legal sense, but diffusion. Risk becomes harder to quantify, easier to ignore. Acquisitions are another favored mechanism. Purchasing revenue is faster than generating it. When growth slows organically, corporations acquire competitors or adjacent businesses to inflate top-line figures. Integration costs and inefficiencies are framed as temporary. Synergies are promised in the future. Meanwhile, revenue grows, justifying valuation. Cash flow may suffer, but expectations compensate. Market reactions reinforce these behaviors. Investors respond positively to announcements of buybacks, acquisitions, and adjusted earnings beats. They reward confidence and punish caution. A company that prioritizes balance sheet strength over growth risks being labeled stagnant. Executives internalize these signals. They optimize for market response, not economic durability. Recent market history offers clear examples. During periods of economic uncertainty, many corporations maintained or even expanded buyback programs despite weakening fundamentals. Debt issuance surged alongside repurchases. The message was clear. Supporting the stock price was more important than preserving optionality. Liquidity was assumed to be available when needed. This approach also reshapes corporate reporting culture. Financial statements become marketing documents. Investor presentations emphasize non-financial metrics, forward guidance, and adjusted results. Risks are acknowledged abstractly, rarely quantified. Language becomes optimistic by default. Precision is sacrificed for reassurance. The cumulative effect is a corporate sector that appears robust while becoming increasingly hollow. Financial engineering does not create value. It reallocates perception. It shifts focus away from productivity, innovation, and resilience toward metrics that sustain valuation narratives. As long as markets accept these narratives, the strategy works. However, this system carries an inherent limitation. Financial engineering depends on external validation. Buybacks require financing. Adjusted earnings require credibility. Acquisitions require access to capital. When market conditions tighten, these tools lose effectiveness. Debt becomes expensive. Valuations compress. Narratives unravel. The danger lies in the lag between reality and recognition. Financial engineering can mask deterioration for extended periods. Investors see stability. Analysts model continuity. Executives project confidence. But underlying economics do not improve. They stagnate or decline quietly. This is how corporations can report success while eroding their foundations. Profitability is replaced by presentation. Strength is inferred from stock performance rather than from cash generation. The business becomes secondary to the balance sheet. By the time the gap becomes undeniable, adjustment is painful. Costs must be cut aggressively. Investment halts. Leverage constrains options. What once looked like efficiency reveals itself as fragility. The same mechanisms that supported valuations amplify downside. Financial engineering is not inherently malicious. It is a rational response to distorted incentives. But when it becomes the primary engine of corporate success, it signals a deeper dysfunction. Markets are no longer allocating capital based on value creation. They are allocating it based on narrative coherence. This shift defines the modern corporate landscape and explains how the largest corporations in the United States can appear relentlessly successful while drifting further away from the economic fundamentals that once defined real wealth. The longer financial engineering dominates corporate strategy, the more deeply it reshapes behavior across the entire economic ecosystem. What begins as optimization gradually becomes substitution. Real operational improvement is replaced by structural manipulation. Over time, corporations lose not only the incentive to improve productivity, but the institutional capability to do so. Balance sheets grow more complex. Operations become less flexible. Decision-making shifts away from engineering, manufacturing, and service quality toward finance, communication, and expectation management. One of the most underappreciated consequences of this shift is the distortion of internal capital allocation. When share price performance becomes the primary indicator of success, investment decisions are filtered through their expected market reaction rather than their economic return. Projects with long payback periods are deprioritized. Investments that improve resilience but do not immediately affect valuation are delayed or canceled. Resources flow toward initiatives that can be framed attractively in earnings calls and investor decks. Substance yields to optics. This dynamic is especially visible in research and development spending. While headline figures often suggest robust investment, the composition tells a different story. Spending increasingly targets incremental improvements, platform extensions, or acquisitions of external innovation rather than fundamental breakthroughs. Buying innovation is safer than developing it internally. It delivers immediate narrative benefits while transferring risk to acquired entities. The result is a gradual hollowing out of internal innovation capacity. Labor dynamics are also affected. Stock-based compensation aligns employee incentives with share price performance, but it also ties workforce stability to market volatility. During downturns, equity compensation loses value, morale deteriorates, and cost-cutting accelerates. Layoffs become a financial tool rather than a last resort. Human capital is treated as a variable expense rather than as a strategic asset. This erodes institutional knowledge and long-term productivity. From a macroeconomic perspective, the prevalence of financial engineering weakens the transmission mechanism between corporate success and economic growth. Rising valuations do not translate into higher wages, increased capital expenditure, or productivity gains. Wealth accumulates in financial assets rather than in real investment. Consumption growth relies increasingly on credit rather than income. Economic expansion becomes fragile, driven by asset prices rather than by output. This fragility is masked during periods of favorable financial conditions. When liquidity is abundant and risk appetite is high, engineered performance appears indistinguishable from genuine strength. Market participants extrapolate recent trends indefinitely. Analysts build models that assume continued access to cheap capital. Policymakers point to stable markets as evidence of economic health. The system reinforces itself. Stress reveals the truth. When financing conditions tighten, the limits of financial engineering become clear. Buybacks are suspended. Acquisition pipelines dry up. Adjusted earnings lose credibility. Attention shifts abruptly from growth narratives to balance sheet exposure. Corporations scramble to preserve liquidity. The same leverage that amplified returns now magnifies risk. Historical episodes illustrate this pattern repeatedly. Periods of aggressive financial optimization are followed by abrupt repricing when assumptions change. Valuations compress faster than operations can adjust. Equity holders absorb losses. Credit spreads widen. Companies once described as market leaders are suddenly framed as over-leveraged and mismanaged. The narrative flips because the underlying economics were never repaired. What makes the current environment distinct is scale. Financial engineering is no longer the exception. It is the norm among the largest corporations. This means that systemic risk accumulates quietly. Correlations increase. When conditions deteriorate, adjustment is synchronized rather than isolated. Many companies face similar pressures simultaneously. Market liquidity evaporates when it is most needed. The role of communication becomes critical in this phase. Corporations emphasize resilience, flexibility, and long-term vision. Guidance is withdrawn or softened. Language becomes cautious. Yet communication cannot substitute for cash flow. Eventually, markets demand evidence. Creditors demand coverage. Investors demand returns. Financial engineering loses its persuasive power. At that point, the cost of past choices becomes unavoidable. Companies that prioritized optics over efficiency find themselves constrained. Assets that were optimized for valuation are ill-suited for adaptation. Balance sheets that were engineered for cheap capital struggle in a higher cost environment. Strategic optionality disappears. The broader consequence is a loss of trust. When markets realize that reported performance was sustained primarily through financial manipulation rather than through economic strength, skepticism spreads. Risk premiums rise. Capital becomes selective again. The very conditions that enabled financial engineering reverse. Profitability, once dismissed as optional, becomes mandatory overnight. This transition is rarely smooth. Adjustment occurs through layoffs, asset sales, dividend cuts, and restructurings. Growth slows. Valuations reset. The economy absorbs the shock. What could have been gradual adaptation becomes abrupt correction because discipline was deferred too long. Financial engineering is seductive because it works until it does not. It offers control in an uncertain environment. It smooths volatility. It rewards management and shareholders in the short term. But it extracts a hidden cost. It weakens the link between corporate success and economic reality. It replaces resilience with fragility, disguised as sophistication. This is the paradox at the heart of modern corporate America. The tools designed to stabilize performance ultimately destabilize the system by delaying necessary adjustment. When profitability is engineered rather than earned, when growth is purchased rather than built, and when valuation replaces value, the appearance of strength conceals accumulated vulnerability. The largest corporations in the United States did not become dependent on financial engineering by accident. They were guided there by incentives, policy, and market behavior. Understanding this mechanism is essential to understanding why apparent corporate wealth can coexist with structural weakness, and why the next phase of adjustment, when it arrives, will feel sudden despite being years in the making. Markets do not merely tolerate this corporate behavior, they actively reward it. The persistence of financially fragile yet highly valued corporations is not a failure of the system. It is the outcome the system currently produces. To understand why, it is necessary to examine how modern capital markets allocate money, how risk is priced, and how incentives have been reshaped over the past decades. The first and most powerful force is scale-driven investing. A significant share of global capital is no longer allocated through discretionary analysis, but through rules-based mechanisms. Index funds, exchange-traded products, pension mandates, and benchmark constrained portfolios direct capital automatically toward the largest corporations. Inclusion in a major index guarantees inflows regardless of profitability. Once a company reaches sufficient size, capital follows mechanically. Performance becomes secondary to presence. This structural demand creates a self-reinforcing loop. Rising valuations increase index weight. Higher weight attracts more inflows. More inflows support higher valuations. The process is detached from operating performance. A corporation does not need to improve margins to attract capital. It needs to maintain relevance and scale. This alone explains why large corporations can sustain weak profitability without losing market support. Active managers, often assumed to be a counterbalance, are constrained as well. Career risk shapes behavior. Underperforming an index by avoiding large names is professionally dangerous. Even when fundamentals deteriorate, managers hesitate to reduce exposure to dominant corporations because doing so risks short-term underperformance. This dynamic suppresses dissent. Consensus replaces conviction. Monetary policy amplifies these incentives. When central banks signal support for financial stability, markets interpret this as implicit insurance. Volatility is dampened. Downside risk is perceived as limited. In such an environment, investors are encouraged to move further out on the risk spectrum. They accept weaker fundamentals in exchange for liquidity and perceived safety. Large corporations benefit disproportionately because they are assumed to be systemically important. Liquidity itself becomes a form of value. Highly traded stocks attract capital because they can absorb large positions without price disruption. This favors large corporations regardless of profitability. Investors prioritize the ability to enter and exit positions over long-term cash generation. Liquidity replaces solvency as a key criterion. Another critical factor is narrative alignment. Markets are not neutral evaluators of information. They are storytelling machines. Corporations that can articulate coherent, optimistic narratives about the future attract capital even in the absence of present profitability. Themes such as digital transformation, artificial intelligence, sustainability, and platform dominance provide frameworks that justify deferred earnings. As long as a story fits prevailing market themes, skepticism is muted. Analyst coverage reinforces this effect. Forecast models emphasize forward-looking assumptions rather than current performance. Price targets are derived from scenarios that extend years into the future. Small changes in assumed growth rates or margins produce large changes in valuation. This mathematical sensitivity encourages optimism. Conservative assumptions appear unjustified in a market environment conditioned to expect support and recovery. Risk assessment itself has been redefined. Traditional measures focused on leverage, coverage ratios, and cash flow stability. Modern risk frameworks incorporate volatility metrics, correlations, and market-based indicators. As long as a stock remains liquid and volatility is contained, it is considered manageable. Structural weakness is obscured by market calm. Risk is measured by price behavior rather than by balance sheet reality. The behavior of corporate management aligns seamlessly with these market preferences. Executives understand that maintaining valuation is often more important than improving operations. Investor relations becomes a strategic function. Earnings calls are carefully scripted. Guidance is managed to meet expectations rather than to reflect reality. Surprises are minimized. Predictability is rewarded. The tolerance for losses is also influenced by relative comparison. In a market where many corporations operate with thin or negative margins, underperformance becomes normalized. Investors compare companies to peers rather than to historical standards. If everyone is unprofitable, no one is punished. Benchmarks drift. What once would have been considered unsustainable becomes acceptable. Global capital flows further insulate large corporations. International investors seeking exposure to the United States often concentrate on well-known brands. Familiarity substitutes for analysis. Capital seeks perceived safety through recognition. This preference channels global savings into a narrow group of corporations, reinforcing concentration and reducing sensitivity to fundamentals. The media plays a subtle but important role. Financial news emphasizes stock movements, rankings, and market capitalization milestones. Profit warnings are framed as temporary setbacks. Structural issues receive less attention than headline figures. This selective focus shapes investor perception. Confidence is sustained through repetition. All these forces converge to create a market environment that systematically rewards size, narrative, and liquidity over profitability and resilience. Corporations respond rationally. They optimize for what markets reward. If valuation is driven by scale and expectation, that is where effort is directed. Efficiency becomes secondary. Discipline erodes not because managers are incompetent, but because discipline is no longer required to succeed. This dynamic creates a moral hazard at scale. Corporations learn that survival and success are decoupled from economic contribution. As long as they remain large, visible, and aligned with market themes, capital remains available, losses can be absorbed, weakness can be deferred, adjustment can be postponed. The danger lies in the accumulation of shared assumptions. Markets assume liquidity will persist. Corporations assume financing will remain accessible. Investors assume intervention will occur if necessary. These assumptions reinforce one another, but they are not laws of nature. They are contingent on policy, confidence, and external conditions. When these conditions change, repricing is swift. Markets that rewarded fragility suddenly punish it. The same mechanisms that drove capital into large corporations accelerate its exit. Index flows reverse. Liquidity dries up. Narratives lose credibility. At that moment, the lack of underlying profitability becomes impossible to ignore. The current system persists because it has not yet been forced to reconcile perception with reality. But the reward structure is clear. Markets are not blind. They are simply responding to incentives. And those incentives favor corporations that master the language of finance over those that quietly build durable economic value. Understanding this explains why the largest corporations in the United States can remain highly valued despite weak profitability. They are not anomalies. They are the logical product of a market that rewards appearance, scale, and expectation above all else. This reward structure does more than distort valuation. It reshapes behavior across the entire financial system. When markets consistently favor size, liquidity, and narrative alignment, they train participants to internalize those preferences as rules. Over time, this conditioning becomes invisible. What appears irrational from a classical economic perspective becomes entirely rational within the prevailing framework. Investors learn that fundamental analysis has diminishing marginal returns when monetary conditions dominate outcomes. Portfolio construction shifts away from deep balance sheet scrutiny toward exposure management. Risk is managed through diversification across assets rather than through selection of resilient businesses. The objective becomes participation, not discernment. Missing a rally is considered more dangerous than holding a fragile asset. This mindset alters how risk is perceived temporally. Short-term volatility is treated as noise, while long-term structural weakness is discounted heavily. Markets assume that time itself resolves problems. Growth is expected to resume. Policy is expected to respond. Capital is expected to return. As long as these expectations hold, present weakness is reframed as opportunity. Fragility is mistaken for flexibility. Corporations exploit this temporal distortion deliberately. By extending guidance horizons and emphasizing long-term visions, they shift attention away from current performance. 5-year roadmaps, transformative initiatives, and future platforms dominate communication. Immediate cash flow constraints are presented as investments in scale. The market accepts this framing because it aligns with its own preference for deferred accountability. The presence of large institutional investors reinforces inertia. Pension funds, sovereign funds, and insurance portfolios require exposure to large, liquid corporations to meet mandate requirements. Their investment horizons are long, but their constraints are rigid. Once capital is allocated, exiting positions is costly and disruptive. This creates a bias toward maintaining exposure even when fundamentals deteriorate. Stability is prioritized over optimization. Regulatory frameworks also contribute. Capital requirements, liquidity rules, and systemic risk assessments implicitly favor large corporations. Banks are encouraged to lend to entities deemed systemically important. Risk weights are lower. Financing terms are better. This regulatory bias reduces funding costs for large corporations regardless of profitability. Access to credit becomes a function of status rather than performance. International dynamics amplify concentration. In an uncertain global environment, capital seeks jurisdictions perceived as stable and institutions perceived as permanent. The United States occupies a unique position in this hierarchy. Its largest corporations function as quasi-global assets. Investors treat them as proxies for stability itself. This perception persists even when underlying economics weaken. The feedback loop tightens during periods of stress. When volatility increases, investors retreat toward perceived safety. Capital flows into the same large corporations that benefited during expansions. Their valuations are supported not because their businesses improve, but because alternatives appear riskier. Weakness elsewhere strengthens concentration here. The system becomes increasingly polarized. This polarization has profound implications for competition. Smaller and more efficient firms struggle to access capital. Innovation is stifled, not by lack of ideas, but by lack of financing. Market share consolidates around incumbents. Pricing power increases. Efficiency becomes less relevant. Profitability does not improve because pressure does not increase. The market ceases to function as a mechanism of creative destruction. Over time, this environment erodes the informational role of prices. Valuations no longer signal economic health. They signal capital flows. Price movements reflect liquidity conditions rather than business performance. This decoupling makes the system harder to read and more fragile. When signals fail, misallocation accumulates. The eventual correction, when it comes, is not triggered by gradual realization. It is triggered by abrupt constraint, a policy shift, a liquidity shock, a geopolitical event, a loss of confidence. At that moment, the assumptions that sustain valuations collapse simultaneously. Markets that ignored fundamentals rediscover them all at once. The repricing is violent because it is compressed. Years of deferred adjustment are forced into a short period. Corporations that relied on market tolerance face immediate scrutiny. Financing costs spike. Access to capital narrows. The same size that once insulated them now magnifies exposure. Their obligations are large. Their flexibility is limited. What makes this transition especially damaging is the absence of preparation. Systems optimized for valuation maintenance are poorly equipped for resilience. Balance sheets engineered for cheap capital struggle under constraint. Organizations oriented toward narrative control lack operational slack. Adjustment requires actions that markets previously discouraged. The broader economy absorbs the consequences. Employment contracts, investment falls, confidence deteriorates. The shock propagates through interconnected balance sheets and portfolios. What was framed as a market correction becomes an economic event. Yet from the perspective of system design, this outcome is not surprising. A market that rewards appearance over substance accumulates risk invisibly. Stability becomes conditional. Success becomes fragile. When the conditions that sustain perception change, reality reasserts itself abruptly. This is why markets continue to reward financially fragile corporations. Not because participants are unaware of the risks, but because the structure of incentives makes awareness irrelevant. As long as capital flows, perception prevails. When capital hesitates, the illusion dissolves. The critical insight is that markets are not broken. They are responding precisely to the signals they are given, and those signals prioritize liquidity, scale, and narrative coherence over profitability and durability. Until that hierarchy changes, the pattern will persist. The question is not whether markets will eventually demand substance again. History suggests they always do. The question is how much fragility will accumulate before that demand returns, and how costly the adjustment will be when perception can no longer substitute for performance. The final illusion sustaining the modern corporate landscape is the belief that the system can continue indefinitely without restoring profitability as a non-negotiable requirement. This belief is widespread, quietly embedded in forecasts, valuation models, and strategic plans. It assumes that access to capital will remain sufficiently abundant, that refinancing will always be possible, and that markets will continue to prioritize continuity over correction. History suggests otherwise. When profitability becomes optional, fragility accumulates invisibly. The absence of immediate consequences encourages complacency. Corporations delay hard decisions. Inefficient structures persist. Capital allocation favors preservation of valuation rather than restoration of economic strength. Over time, this produces organizations that appear stable but lack adaptive capacity. They function well under favorable conditions and poorly under stress. The reemergence of profitability as a requirement does not occur gradually. It arrives abruptly, triggered by constraint. The constraint may come from higher interest rates, tighter credit standards, regulatory pressure, geopolitical disruption, or a shift in policy priorities. The specific catalyst is unpredictable. The mechanism is consistent. Capital becomes selective. Risk is repriced. Cash flow regains importance. Early signals of this transition are often misinterpreted. Rising financing costs are dismissed as temporary. Credit tightening is framed as cyclical. Earnings pressure is explained away as transitory. Markets oscillate between optimism and concern, searching for reassurance. Corporations respond with cost-cutting, selective divestments, and communication adjustments. These measures buy time but do not restore fundamentals. As constraints persist, the calculus changes. Refinancing becomes more expensive. Debt maturities approach. Interest expense consumes a larger share of operating income. Financial flexibility narrows. Choices that were once deferred become unavoidable. At this stage, profitability is no longer a strategic option. It becomes a survival condition. The consequences are uneven. Corporations with strong pricing power, disciplined cost structures, and genuine cash generation adapt. They absorb higher financing costs, reduce leverage, and stabilize operations. Others struggle. Business models built around continuous access to cheap capital face existential pressure. What was once framed as a temporary setback becomes a structural problem. Market behavior shifts accordingly. Valuations compress. Multiples contract. Growth narratives lose credibility. Investors differentiate rather than aggregate. Capital flows fragment. Size alone no longer guarantees support. The market begins to ask questions it previously ignored. How much cash does the business actually generate? How resilient are margins? How sustainable is the capital structure? This repricing process is disruptive because it reverses years of accumulated assumptions. Assets that were priced for continuity must be repriced for constraint. Balance sheets optimized for expansion must be restructured for survival. The adjustment is painful because it is delayed. Had discipline been enforced earlier, adaptation could have been gradual. Deferred discipline concentrates adjustment. Economic data during such transitions often appears contradictory. Employment remains strong while investment weakens. Revenues hold up while profits fall. Markets fluctuate violently without clear direction. These are signs of a system in transition, struggling to reconcile perception with reality. Corporate responses during this phase reveal underlying strength or weakness. Companies that invested in resilience reduce leverage proactively, accept lower valuations, and rebuild credibility. Companies that relied on financial engineering attempt to preserve appearances longer, exhausting remaining options. When adjustment finally occurs, it is sharper. The broader economy absorbs the spillovers. Capital expenditure slows. Hiring freezes spread. Innovation budgets are trimmed. Consumer confidence weakens as asset prices correct. The wealth effect reverses. What began as a financial repricing propagates into real economic activity. This phase is often described as a crisis, but it is more accurately a normalization. Profitability resumes its historical role as the gatekeeper of survival. Access to capital becomes conditional rather than assumed. Markets reassert their disciplinary function. The illusion of frictionless continuity dissolves. Importantly, this transition does not imply the collapse of all large corporations. It implies differentiation. Some adapt and endure. Others contract, merge, or disappear. Creative destruction resumes, albeit after a long delay. The cost of that delay is borne by employees, investors, and the broader economy. What makes the current moment distinctive is the scale of potential adjustment. The concentration of capital, the prevalence of leverage, and the normalization of financial engineering have elevated systemic sensitivity. When profitability becomes mandatory again, the impact will be felt across sectors simultaneously. This does not require catastrophe. It requires persistence of constraint. A world in which capital is no longer free, but not prohibitively scarce. A world where refinancing is possible, but conditional. A world where narratives must be supported by numbers. In such a world, the rules quietly change. Corporations that thrived under the previous regime must relearn old disciplines: cost control, return on invested capital, balance sheet strength. These concepts never disappeared. They were merely sidelined. Their return will feel abrupt because memory has faded. The lesson of this cycle is not that markets were irrational. They responded to incentives. They rewarded what policy and structure encouraged. The illusion was systemic, not individual. When incentives change, behavior follows. Profitability has not been abolished. It has been deferred. The deferral created an appearance of stability that masked growing vulnerability. When the deferral ends, adjustment follows. The final reality is simple. Wealth built on expectation is fragile. Wealth built on cash flow endures. The largest corporations in the United States appear wealthy because the system allowed them to postpone proof. When proof is required again, the difference between appearance and reality will define the next phase of the economic cycle. When this transition accelerates, its most revealing feature is not collapse, but selection. The system does not fail uniformly. It differentiates with brutal efficiency. The corporations that survive are not necessarily the largest, the most famous, or the most celebrated. They're the ones whose internal economics still function without constant external support. The rest discover, often too late, that scale without profitability is not protection, but exposure. In this phase, capital markets undergo a subtle but decisive change. They stop asking whether growth will return and start asking whether survival is assured. The language of investment shifts. Phrases like optionality, runway, and narrative momentum fade. They are replaced by cash conversion, coverage ratios, and balance sheet durability. Analysts rediscover basic questions that have been dormant for years. Can this business fund itself? Can it service its obligations? Can it withstand prolonged constraint? This shift has immediate consequences for valuation. Multiples compress, not because pessimism spreads, but because assumptions change. Discount rates rise, terminal values shrink. Growth projections are shortened. What once justified premium pricing no longer does. Valuation becomes arithmetic again, rather than aspiration. The repricing feels violent only because expectations had drifted so far from fundamentals. Corporate behavior adapts accordingly. Capital allocation becomes defensive. Buybacks are curtailed indefinitely. Dividends are reassessed. Acquisition strategies collapse under scrutiny. Balance sheet repair replaces expansion as the primary objective. Management teams that once spoke fluently about vision and transformation now speak cautiously about discipline and efficiency. The rhetoric changes because the audience changes. Markets are no longer impressed by ambition. They demand evidence. Labor markets reflect this adjustment with a delay. Employment remains elevated initially because firms attempt to preserve capacity. But as margins compress and financing costs persist, labor becomes the largest adjustable variable. Layoffs spread across sectors previously considered insulated. The justification shifts from efficiency to necessity. The social cost of deferred discipline becomes visible. At the macro level, the economy experiences a paradoxical slowdown without an obvious trigger. There is no single shock to blame. Instead, there is a collective withdrawal of excess. Investment decelerates. Risk appetite declines. Consumption weakens as asset prices adjust. Growth slows not because demand disappears, but because leverage is no longer expanding. An economy accustomed to debt-fueled momentum struggles to adapt to balance sheet repair. Policymakers face a dilemma in this environment. Intervention can delay adjustment, but at the cost of reinforcing the same dependencies that created vulnerability. Non-intervention accelerates correction, but risks political and social backlash. The temptation to smooth outcomes remains strong, yet each attempt to suppress discipline increases the eventual cost. The system oscillates between restraint and relief, extending the adjustment over time. This prolonged normalization creates fatigue. Markets grow impatient. Investors rotate frequently, searching for certainty. Volatility becomes structural rather than episodic. Confidence does not collapse, but it does not fully recover either. The era of effortless valuation expansion ends quietly, replaced by an environment where returns must be earned rather than assumed. For corporations that adapted early, this environment offers opportunity. Reduced competition, disciplined capital markets, and renewed emphasis on fundamentals reward businesses that generate real cash flow. These firms gain pricing power not through dominance, but through reliability. Their valuations stabilize because they are supported by earnings rather than expectation. They become anchors in an unstable landscape. For those that failed to adapt, the outcome is less forgiving. Asset sales, restructurings, and mergers become unavoidable. Equity holders absorb dilution. Creditors impose terms. Management teams are replaced. The transition is painful, but it restores clarity. Capital flows away from narratives toward operations. This is how the illusion finally dissolves. Not through collapse, but through recalibration. The system remembers its own rules. Profitability resumes its role as the ultimate validator. Size remains an advantage, but only when paired with efficiency. Brand recognition retains value, but only when supported by cash generation. The long-term consequence of this shift is not stagnation, but renewal. Capital becomes selective again. Innovation regains relevance because it must improve productivity rather than merely expand scale. Competition reemerges as a force. The economy slows initially, then stabilizes on a more durable foundation. Yet the memory of the previous regime lingers. Corporations remain cautious. Investors remain skeptical. The scars of repricing influence behavior for years. Growth returns, but it is measured. Valuations rise, but they are restrained. The excesses of the past are not repeated immediately. The lesson of this cycle is not ideological, it is mechanical. When profitability is treated as optional, systems drift toward fragility. When it becomes mandatory again, adjustment follows. The delay between those states determines the severity of the transition. The largest corporations in the United States appeared wealthy because they operated in an environment that rewarded postponement. Their valuations reflected faith in continuity rather than proof of strength. When continuity could no longer be assumed, proof became required. This is not a condemnation of scale, finance, or markets. It is a reminder of their limits. Capital can amplify success, but it cannot replace it indefinitely. Narratives can sustain confidence, but they cannot service debt. Liquidity can delay reckoning, but it cannot eliminate it. In the end, wealth that endures is not measured by market capitalization or brand ranking. It is measured by the ability to generate cash under constraint, to adapt without rescue, and to survive without illusion. When profitability returns as a requirement rather than a preference, the difference between appearance and reality becomes impossible to ignore. That moment does not arrive with an announcement. It arrives quietly, through changed behavior, altered incentives, and redefined expectations. By the time it is widely recognized, the transition is already underway. If you want to understand where this system is heading, stop watching headlines and start watching cash flow. Stop asking which companies are the biggest, and start asking which ones can survive without refinancing. Stop trusting narratives designed for markets, and start reading balance sheets designed to hide reality. The next phase of the economy will not be decided by innovation slogans or stock market records. It will be decided by which corporations can function when money is no longer free, when belief is no longer enough, and when profitability returns as a condition of survival. If this analysis changed the way you look at the biggest brands in America, stay here. Because the real story is not about how powerful these corporations appear today, it is about which of them will still exist when appearances no longer matter.